Welcome and thank you for joining part one of our Landlord Investor Seminar. This will be a three-part series, and today we'll be talking with Joseph Trombetta, who is the owner of the Titan Mortgage Group. He's also a very experienced and seasoned investor himself, holding over 150 units in the Hamilton area alone. Are rental properties still safe for investments? I hope you enjoy this video, and please stay tuned for the other two coming up soon.
Titan Mortgage Group has been around now for well over 23 years. And I've been in the industry, as you know, a little bit more than you, Carrie, about 33 years. This business has evolved. And one of the things that I've always looked at is there are two things that most investors and clients want to do is that they want to strategize to create wealth, but the preservation of wealth is very important. So when we look at preservation of wealth, these are the methods that we're going to be talking about is when we're renting properties out, and we get a derelict tenant, these are some things that we need to we're constantly refining ourselves. We're trying to improve ourselves. And this is what you're trying to do here today, Carrie, is that you're trying to help the investors to realize that how can we preserve our wealth when it comes to renting properties? Because we're trying to make money. Everybody's trying to make a rate of return when it comes to multiple doors. Okay. And there's some opportunities here. I think as time goes on over the next several months to years, you have a government that needs to provide housing to Canadians. There's a lack of homes, a lack of units and options for clients. So when it comes to trying to leverage your portfolio and trying to get the best rate of return for your money, that's where you maximize, right?
You have been obviously a landlord for a number of years now, 150 doors. That's quite impressive. Would you agree that purchasing income properties, as residential income properties, is still a relatively safe investment?
Today, with the cost of inflation, it's more and more trying to maximize your cash flow on any property is important. But inflation, if you can buy a property that you can rent out, mm-hmm. and you have a certain fixed rate. We came from low emergency interest rates, okay, where we were having some of our mortgages that we locked in and we didn't have options. When you're borrowing up to 20% on a $30 million project, of course, you're trying to get the maximum amount of money on it. Of course, coming with low interest rates where they were, like I locked in one mortgage for 2.69 for 10 years. Of course, that carries a lot more money on that building with that form of rental income that was provided at the time. Mm-hmm. So if you have inflation at 6 or 7%, let's say it was at 8 or 9, but let's just say 6 or 7, and your cost of funds are at 2.69, you're actually making money by just making the mortgage payments. Mm-hmm. You're making money, and that's because of the inflation rate. Understanding inflation, okay, is a killer when it comes to purchasing power. So the higher the inflation rate, the less purchasing power an investor will have. So if an investor can buy a building and lock in the rate for long periods of time, in this case here, below inflation rate, okay, that's your way of doubling and tripling your real purchasing power as time goes on, right?
Yeah.
In the future.
Yeah.
Your inflationary equity, whatever you want to call it. Yeah.
Now, I'm sure you've dealt with all kinds of tenants. You've had amazing situations and maybe some that aren't so amazing. What advice would you have to a newer investor or somebody wanting to get into purchasing income properties when it comes to minimizing risk with the tenant?
Okay, you've heard me talk once or twice before, and I'm going to tell you a term today. It's called mastering the art of losing money with style, okay? It's so important that you understand that, okay? Because when you're an investor, you got to kind of take it with a grain of salt, because sometimes things don't go the way that you plan things, okay? So you plan to put the best tenant in your buildings, okay? Paying well, giving you top dollar, okay? But shit happens in people's lives, okay? People decide, it's time to get a divorce, or sometimes people get sick, unemployment. Remember, you're the landlord and you're dealing with these people where their set of circumstances have changed. They can't pay rent anymore. Okay. Yeah. Mental illnesses are on the rise. Okay. Yeah. People stressed out beyond their control sometimes, right? They're getting sick, right? So when you have one of those, it's basically you look at your overall picture and you try to project yourself where you're going to be 3 years from now, 18 months from now, 10 years from now. And you say, overall, if the building continues to get stronger, in a sense, the rents keep going up, that means your rate of investment will climb. That's what you have to look at it. So you can't look at, just because you have one tenant in this building, all of a sudden, oh wow, I'm throwing it away. I'm not gonna be an investor anymore. You can't look at that. You got to look at the long run. Okay. Similar to some of the people that invest money in stocks and bonds, right? Yeah. Look at your horizon. What's your investment horizon? Your investment horizon's 5 to 7 years. That's what you should be looking at. Don't look at your day-to-day dealing with tenants. Mm-hmm. That will give you your quality of, like your peace of mind. You can't look at that. You got to look at it on the long run. Do we get upset from time to time? Yeah, sometimes. Yeah. Sometimes. Especially when you try to help a friend.
Oh, right.
A friend in need.
Can we agree that having multiple doors on one property minimizes your risk, as opposed to renting out as a single family home? For the smaller investors out here, can we agree that that's probably a better idea?
So I just, like, it depends on the investor's goals, I would say. But if you're looking at, like, for me, I'm always looking at maximizing our investment on any given property that we have. So a single family home, we might not have a lot of capital tied up on that property, and based on the rents, it might be advantageous for us based on our investment goals on that one particular property. Okay. But overall, we always look at maximizing. Okay. So in Hamilton, I think you guys know about the bylaw change that came into effect.
Yes. Right? Let's talk about that. Yeah.
Yes. For a lot of lenders have not picked up. They've always had an income approach for owner-occupied properties that have rental incomes. If they're separate, the detached, they will consider taking that rental income as part of the overall income, right? For servicing the debt that you're looking at getting for the property, et cetera. Mm-hmm. But if you're looking at, in Hamilton right now, so for example, a bungalow, okay? You have the upstairs unit and you have a basement that has these egress windows already installed. Maybe look at investing some money into the basement to turn it into an apartment building or into an apartment, right? Or the detached structure, converting that into those little coach housing, as they call it, right? There's certain areas and pockets that are probably better to convert in certain areas, okay? Mm-hmm. But with me, it depends on what the purchase price is. But if you can get your unit costs down below $250 per unit, okay, for Hamilton, it's a good deal. Okay. And you can leverage. So $750, 3 units, you can do well in Hamilton. Okay. Keeping as a guideline in mind. Nice. Even with today's interest rate environment.
Yeah, something about, having multiple units in one home gives me a peace of mind, where if somebody can't pay their rent 1 month, I'm not losing all of it, right?
But master the art of losing money with style when you're an investor.
I hate it. I don't know. It can be really stressful. But again, as a realtor, owning income properties, owning multiple properties is my retirement. So for those of us that don't have a retirement, this is a great way to create one.
Yeah, no, I agree with you. But I think for anyone, for a retirement plan, to own a basket of investment properties is not a bad thing. Yeah,
Yeah,
not
absolutely.
thing. Yeah.
Obviously, you're my go-to lender for anything really.
So does everybody know that it's Joe and Gina, right? Like there's two of us here, right?
I know.
Like the key to take away is your investment goals are so important to align when you're getting involved in rentals. Okay. It's they're not guaranteed. Like rents are not guaranteed. That's the risk part of anything that you get involved in when it comes to investments. Okay. There's a very high risk and probability that your tenant could put financial situation could change. And if that happens, you have to look at what could happen to you. So should you be always in a position of having 3 to 4 or 5 months worth of mortgage payments for that property set aside? And I think that's prudent. Okay. And today's days of high inflation, I agree that we should always have a little bit of a nest egg set aside. But not all tenants are terrible out there, right? No. There's a lot of great tenants. I would say 99.5% of the people that are renting are phenomenal. That 0.1, it's shitty things happen to good people sometime.
Yeah.
That happens. Again, I already said it. Mental illness, right? Unemployment, right?
Yeah.
Set of circumstances change for people, and divorce, separations. Again, that's life. That's what happens when you rent as an investor, right? And you got to take it in with a grain of salt. But and it depends on what properties you have. Like we categorize properties today, like A property, B property, or C property. Of course, C properties, you're going to have higher delinquencies than an A property. Okay, an A property during COVID, there was some statistics that were shared with us from a group in Hamilton that A properties during COVID, 98% of the people paid their rents on time. 98%. And the B properties, it was in the high 80s. And C was about 82%. It was very, very.
That's
so,
not
but again, it depends on the type of property. Luxurious versus maybe a rundown building.